Rate of return. That is the amount earned on an investment during a set time frame. It is calculated by taking the current value of an investment, subtracting the initial value, dividing that total by the initial value, and multiplying the results by 100. To put this into perspective, if you purchased a share of Apple stock today for $130 and sold it later for $150, your rate of return would be about 15%. Banks actually provide a small rate of return, usually around 0.05%. So if you have $5,000 in your savings account, you would get around $25 every year. It's pennies on the dollar, really. Now, aside from investing in real estate or land, there are really only two main ways people can earn a rate of return on their money: stocks or cryptocurrency. A lot of you are probably thinking, well, you left out a third, 401ks. However, for the sake of this discussion, assume that when I'm talking about stocks, I'm also lumping in 401ks, because at the end of the day, both are portfolios consisting of corporate companies or mutual funds. The major difference between the two is the fact that employers normally match up to 50 cents for every dollar you invest in a 401k. This match is usually only up to 6% of your salary, meaning if you make $50,000 a year and invest 6% of that into a 401k, it would add up to around $6,200 a year. So your employer would contribute $3,200 on top of your investment. When you invest into a 401k, you don't have as much control on your overall investments because you are buying into diversified funds that contain a multitude of different stocks. These are managed by large firms which do their best to minimize risk and grow your investments across a diverse set of assets. For the most part, 401ks have proven to be extremely safe with an average rate of return between 3 and 8%. If you want to invest in an individual stock, you can choose exactly which company you want to buy into and purchase a set number of shares that represent your equity in the company. This is where the term shareholders comes from, and all public companies listed on a stock exchange have to report to the shareholders and account for their actions, both good or bad. The average rate of return for stocks tends to be around 10%. This means you can expect your money to grow at this rate year over year. Really good investors hope to be in the area of 15%, but that's a challenging goal to achieve. Now, if you're like most people, I would assume that your knowledge of cryptocurrency involves Bitcoin. That is because it was the very first cryptocurrency ever created and the most popular by a long shot. And being completely honest with you, I had no idea what cryptocurrency was until the giant Bitcoin craze a couple of years ago. Ultimately though, crypto is a digital currency that is secured by cryptography, which is defined as the art of writing or solving codes. The thing that makes cryptocurrency so valuable is the fact that it is not issued by any central authority. So whereas national currencies like the US dollar are regulated by governments, crypto can theoretically remain immune to any type of interference or manipulation. Think of it this way: cryptocurrencies like Bitcoin can provide a steady currency for transactional exchanges in countries where the government issued money is worthless. This makes it extremely valuable. So how does crypto get its value? The value of crypto is derived from the demand and overall community involvement. So much like how a stock's price can be driven up by positive factors on the corporate balance sheet or a recent news headline, crypto's value is also driven by the underlying factors which affect the demand. The reverse can apply as well. Negative factors will lead to a dip in price. Supposedly, crypto can yield a higher rate of return than stocks, but because it's only around 13 years old, there's not a lot of historical basis to go off of when comparing it to the stock market. However, let's dive in and look at the performance of some actual stocks and cryptos. Tesla, AMD, Zoom, Shopify. These are some of 2020's highest performing stocks. If you had invested in Tesla towards the end of 2019, your rate of return today would be around 667%. The same holds for Zoom at 460%, Shopify at 200%, and AMD at 97%. Alternatively, some of the top cryptos for 2020 showed equally positive results. If you had invested in Bitcoin at the same time as Tesla, your rate of return would be around 243%. And the same holds again for the other top cryptos, with Ethereum at 400% and Litecoin at 217%. So what causes the fluctuation of price for stocks or cryptocurrencies? Volatility. Volatility represents the variation in price around the average value of a specific asset. Now, technically, volatility can encompass both positive and negative gains, but for the sake of this argument, when I talk about volatility, assume that I am referencing it from a negative standpoint, meaning that volatility represents a dip in price. Ultimately, volatility is caused by several factors, such as corporate earnings, bad news, change in leadership, or economical downturn. All of these contribute to the overall consumer demand, which is really the foundation for all economics. If the demand exceeds the supply, then the prices tend to rise. When the supply exceeds the demand, then the prices tend to fall. This law holds true for any transaction. All you have to do to confirm this theory is look back to the beginning of COVID and see the spike in the price for hand sanitizer. Volatility is something that all investors want to avoid. In a perfect investment world, a portfolio would consist of stocks or crypto that never dip below the point you purchase them at. The world doesn't work that way though. There's no single stock or crypto that can escape volatility. The main problem with volatility is that it can drastically lower the overall value of your investments. COVID is a great example of this. In 1 month, the Dow Jones Index lost a third of its value and plummeted from a high of 28,000 points to around 18,000 points. The airline industry was one of the hardest hit in the pandemic, with one of the largest airline manufacturers, Boeing, dropping from around $330 a share to $95 at its lowest point. And the other airline companies like Delta, United, Southwest followed a similar trajectory. Other industries like oil and gas were hit especially hard as well. Crypto was also hit. The value of Bitcoin plummeted from around 9,000 to 5,000. There are a ton of examples I could reference of stocks or crypto tanking, but if I did that, this video would never end. At the end of the day, when volatility exists, it makes it more difficult for you to liquefy your assets into cash, because they might be valued less than what you originally paid for them. And yes, I know a lot of you are thinking the stock market has gone up historically in the long run, and that is true. On average, the stock market provides around a 10% rate of return, and cryptos are supposedly higher, but volatility makes consistency hard to achieve. So what if you could invest your money in an asset that never dipped below the price you paid, and was guaranteed to provide a higher rate of return than most stocks and crypto combined? This would be the ideal type of investment because it would allow you to liquidate your assets at any moment while growing your money at an exponential rate. This type of investment actually exists, and no, you don't have to download an ebook or sign up for a webinar. It's called Retired Lego, more specifically, Retired Star Wars Lego. When I say retired, I mean Lego sets that will never be released again. Think of it as limited edition. Over the past 22 years, LEGO has created around 772 different Star Wars sets. I analyzed all of these sets on a website called Brick Economy, which is a great catalog for everything LEGO. I'll link it in the description so you can check it out. I looked back across every year that LEGO has produced Star Wars sets, and I could only find a couple of instances of sets being worth less than they originally retailed for, and all of those tended to be based off of the newest Star Wars movies produced by Disney. Personally, I think these outliers can be summed up by the failure of The Last Jedi, which really divided the Star Wars fan base. In fact, the worst performing sets of all time tend to be those made on the new sequels directed by Disney. That's a topic for another video though. Luckily for me though, Brick Economy has the original retail price and current value of every Star Wars set ever created. So I was able to compile all of the data into an Excel sheet and analyze the information on a more detailed level, and the findings were extremely interesting. Let me break it down for you. Since 1999, LEGO has released a varying amount of Star Wars sets every year, and this is shown by column 2. Column 3 shows the total retail value for all sets released in a given year, while column 4 shows the current value of those sets today. Across every single year, LEGO is worth more today than it was when it was originally released. And yes, some of this is due to inflation, which roughly occurs at around 2 to 3% every year. However, let's take a step back really quick. Stocks have an average yearly rate of return of 10%, and cryptos are supposedly higher than that. So let's say cryptos have an average yearly rate of return of 15%. You know what the average yearly rate of return for LEGO is? 28.25%. Now, you probably think my math is wrong, and I can assure you it's not. Going back to our rate of return formula, I'll show you exactly how I got these numbers. First, I calculated the total rate of return for each individual year that LEGO released sets. Using these numbers, I calculated the average rate of return across all years, which amounted to 365%. Next, I calculated the yearly rate of return for each individual year starting in 1999 by dividing the total rate of return by the number of years that have elapsed since the sets were first released. I then took the average of all these yearly rate of return numbers and arrived at 28.25%. Confusing, right? So to simplify things, the average rate of return from 1999 to 2020 for Star Wars LEGO is 365. Simplifying things even further, the average yearly rate of return for sealed Star Wars sets across all years is 28%. Now, for a split second, let's completely ignore everything I just said and simply look at column 7, which shows the yearly rate of return for every year that LEGO has released Star Wars sets. 2016 appears to have the lowest yearly rate of return of any year at 8%. That's only 2% less than stocks. Even if you averaged an 8% rate of return on your investment, you would be doing so with zero risk because there's no volatility in LEGO. It holds its value extremely steady and always heads in an upward trajectory. This is because historically LEGO has proven to be immune to volatility. The same does not hold for stocks or crypto. You always run the risk of having a negative rate of return. With Star Wars LEGO, that's never an issue. You are guaranteed to make money on your investment, and in most cases the sets skyrocket in value as soon as LEGO stops making them. Now, obviously, there are a lot of factors which affect the value and rate of return of a Star Wars LEGO set. The most important factor is exclusivity. What do I mean by exclusivity? Well, LEGO tends to update and release previously made sets with newer versions every few years. The best example of this is the Slave 1. The first version of this set was released in 2000. Since then, LEGO has released 7 more versions. This same pattern applies for a lot of other classic sets like X-Wings, Walkers, and TIE Fighters. After all, at the end of the day, LEGO is a for-profit company, so if sets like the Slave 1 are an easy sell to consumers, why not keep selling an updated version every few years? What's interesting is that even though the Slave 1 has been released consistently since 2000, every version is now worth more than its original retail price. However, the rate of return on sets that LEGO keeps producing is definitely much slimmer than sets that are never released again. It is impossible to ever predict if LEGO will release an updated version of a set, but in my experience, LEGO tends to release sets that represent the Star Wars content that has been produced in the past or is currently being produced in the present. And now that Disney is producing loads of Star Wars content, I don't see that changing in the foreseeable future. The LEGO sets with the highest rate of return are the ones that are never released again and those that come with exclusive minifigures that can't be purchased in any other set. You really can't lose money investing in sealed Star Wars LEGO. However, if you want to maximize your rate of return, then you need to have a good understanding of LEGO's backlog, meaning you should research what sets and minifigures have been produced in the past. To provide some insight, I recently purchased set 75280 because it's one of the only sets LEGO's ever made that comes with the 501st Clone Trooper. The only other sets that LEGO has released with this minifigure are sets 75002 and 75004, which have since yielded a 300% rate of return for anyone who purchased them back in 2013. So what's the point to all this? Ultimately, when you bet on the stock or crypto market, you're gambling to some extent. Yes, you can research and make educated guesses based on the current track record or future growth potential, but at the end of the day, if volatility exists and your money is at risk. Now, obviously, you might hit big and invest in a Tesla or a Bitcoin, but you might also invest in a Boeing right before the market falls out. And let's be honest, most people are hardly ever able to land investments like Tesla or Bitcoin. If we did, then I wouldn't be making this video. Historically, the stock market has proven to go up since its inception, so if you can hold on to your investments, most likely you'll end up with more money than you put in. I can't say the same for crypto, but it seems to follow a similar trend to the stock market. Data doesn't lie. If you invest in stocks, you should average a yearly rate of return of around 10%, give or take. If you invest in cryptos, you might do a little better than that or a whole lot worse. If you invest in LEGO, you can average a yearly rate of return of around 28%, and your investment is guaranteed to hold its value with no volatility. Now, I guess one thing I should mention is that all of the math I did for this discussion was accounting for diversification. That is to say, if you went all in on one LEGO set, stock, or crypto, then these rate of return numbers would probably deviate quite heavily. So ultimately, it's never good to put all your eggs in one bucket. Make sure you branch out. I spent a ton of time gathering all this information, and I'd love to hear your thoughts on this discussion. So please leave a comment below. Thanks for watching, and I'll catch you in the next one.